Introducing the new DocsTradingPost.com, your online survival superstore for the lowest priced guns, ammunition, and optics available online. Prepare today at DocsTradingPost.com. This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, we've had a big week for the precious metals, particularly gold, as the U.S. market has, what some say, started into the correction phase. Here on Friday, the Dow plunged more than 500 points, the first time in, about 4 or 5 years, Eric, and it's, down about 1,300 points on the week?
Yeah, quite a bit.
Gold and silver, a little bit of positive news finally this week after recent lows. Gold back well above 1150 early today, near 1170 before a little bit of a correction in the London trading, and then traded really between 1150 and 1160 throughout the U.S. market, and closing on the highs for the day here in access trading right now on Friday's session. Silver not quite as strong today, but still closing well above 15, but I guess somewhat not too surprisingly has been knocked down for the weekly close under that somewhat critical 1550 level. So what's your take on the precious metals trading here today? Well, this week, and then culminating with today's action, Eric.
Yeah, it's been basically since August that we turned around in the precious metals, and in July we hit a level of sentiment lows that I frankly have never seen in my entire time, 25 years of watching financial markets, and adding on top of that my study of the markets, I don't think we saw anything worse ever in the precious metals in terms of the negative sentiment that's been out there and that we've been documenting. I don't know, man. You took off. You had a child, and last week we took off and didn't do a show because you were passing a kidney stone. So maybe we shouldn't be recording and just kind of let the markets do what they want. But on a more serious note, these kind of things are, John Templeton made a career out of advocating for not only buying when blood is running in the streets, per the Rothschild saying, but just maximum pessimism is the point at which one should be the most aggressive. When you feel like you want to just hide under a rock when market action is so unbelievably painful, that's the time, in fact, when it's wise to go and start, buying around the edges, maybe not going and getting really aggressive or what have you, but that's what we just saw in the last, since basically the start of this month. The sector has begun its period of rejuvenation. When we had Turd on the show 2 weeks ago, we were talking about how it looked like the sector was going to try to put in a bottom and turn around that following week. That's exactly what we saw. And it corresponds to the much larger cycle in the calendar year of buying that comes out of Asia. India buys a lot in anticipation of the wedding season and the holiday season, and all of the jewelers and the refiners and the entire supply chain basically sucks down a huge amount of gold starting from August throughout the rest of any given calendar year. Something very similar happens in China as well, and we have seen the reports coming from the refiners and jewelers and sellers and wholesalers and so forth in the media, mostly within the Chinese and Indian press, mind you, not something that's aggressively reported in the West, because frankly they like to bury these stories. So what we see now makes a lot of sense. It fits previous patterns, and I think when you layer on top of that the fact that the U.S. Stock market is now finally rolling over, whereas before there were, if you look at Europe, if you look at other stock markets, and maybe even you can sort of count what happened in China, although their cycle, that market definitely runs to a different drummer's beat. I mean, in any event, the United States stock market was considered a safe haven, a form of asset parking where people can get out of the lunacy of what was going on in Europe earlier with Greece, and we'll get to that in a moment too, because the next chapter in Greece is unfolding as we speak. All of that has already played out, and it is now high time for people to be rightfully fearful about the U.S. stock market, and we're seeing that getting priced in. Corporate earnings have been weak. The economy has been very, very sluggish, And even in now, within the last month or so, or last 2 months, you've seen a lot of reports with leading economic indicators and industrial production, and wherever you look, you see that the economy is, even by government statistics, is beginning to show a negative pattern. And then we have this deflationary wave that's expressed very clearly in oil. Some of that's just excess supply, in addition to weaker demand because of weaker economic activity. But nonetheless, it's still happening, and it's freaking people out. So it's quite telling when almost, if not the only market segment that is working this week is precious metals versus the vast majority of the rest of the market. So I think that's going to start catching a lot of attention. I wouldn't be surprised if the powers that be come in very late Sunday night and buy a whole boatload of S&P 500 futures and try to stem what's been going on in the last 2 days. So I don't think we're going to go straight down. But this it fits pretty much with the forecast that I was talking about late last year in the fourth quarter, where the summer would start a crisis period, crisis window, and that in the fall we'd have a pretty substantial stock market correction, and that upwards maybe even as much as 20% on the S&P 500, and that would begin the process of people thinking about a reversion to QE, that the Fed would stop jawboning about a normalization of interest rates. And the biggest thing that the Fed is concerned about, above and beyond everything else, is asset prices. Assets falling is very bad for the banks, and the number one constituency for the Fed are the banks. I mean, in a roundabout way, actually in a direct way, when it comes to the most important segment of the Fed, the regional 12 boards, and in particular the New York Fed, they're owned outright by the banks. So it's not a surprise that the biggest constituency that they follow is what's going on with the banks and their balance sheets. And as asset prices fall in the coming weeks, when this correction gains a little bit more steam, I think that any discussion about the Federal Reserve normalizing interest rates is going to go out the window, and that they're going to outright, in a high probability, come out in September and say that interest rates will most likely not be raised throughout the rest of the year.
I want to give the listeners a quick update on the physical markets here in the U.S. and gold and silver. Last week, in lieu of the Metals and Markets show, as Eric discussed, I was a little bit under the weather. Released an update on what we're seeing across the wholesale market. For the most part, things have continued this week. The Royal Canadian Mint did release an allocation of silver maples, so things have eased just slightly on the maple side. Really haven't seen any decrease in premiums at the retail level, or wholesale either, I should say, on maples. Silver Eagles, if anything, have tightened a little bit further this week. We were actually at SDBullion, we're down to our very last tube of Silver Eagles here this afternoon, until we did get a truck in from the Mint with, maybe 30 or 35 monster boxes. So we got a few days worth of Silver Eagles, as long as they don't hit the market again. But the U.S. Mint didn't take them long again this week to sell out their allocation. And looking at their sales numbers for August, they're up to about 3.4 million in August versus 5.5 in July. But really, it's not at all because they can't sell as many coins as they did in July. It's because the U.S. Mint won't sell the authorized purchasers as many coins as they did in July, when they had production shut down for the few weeks before that. So annual sales are up to closing in on 31 million ounces, and we're still in August, which is quite amazing. So it's certainly looking like, it's not quite in the bag yet, but it looks like it's quite likely we'll see a new annual sales record in Silver Eagles.
Unless they suspend sales altogether.
Right, unless they suspend sales for the fourth quarter, which I wouldn't put it past them. But
that's already happened twice in the last 2 years.
Right, and they're actually, we heard from one of the authorized dealers last week that, and this wasn't any official release that the U.S. Mint put out, but one of their reps was warning that, they're just warning their rep that, we actually might, this year we might move over to make the switch over to the 2016s in September, which to me is a pretty big red flag that they either don't have any blanks or are short production in some capacity. I mean, it certainly does not take 4 months to change dies over. I don't care if you get 20 presses. the private sector, private mints it takes about an hour to change dies out in a press. So
they did that last year, but do you remember off the top of your head what month it was that they made that?
They've done it the last couple of years. They've done it earlier and earlier, but I believe it was around December 6th last year that they shut down sales while they ramped up for January of the 15 coins. Previous years, it's been about mid-December, so we don't have any confirmation of that, but that was something I was told in a personal conversation of one of the head traders, one of the authorized dealers, of a conversation they'd had the same day with the U.S. Mint. So whether they're just blowing smoke or whether they're about to use that as an excuse to shut down sales for the rest of the year, we'll see. It'll be interesting. Really across the board, really haven't seen any sort of significant easing at all in supply or premiums this week. For the most part, things have probably held serve from what we were looking at last week across the retail market.
As we have bottomed in August 1st and have largely been moving up since, have you seen a commensurate number of people coming in and chasing the price higher and wanting to buy?
Yesterday, when China was falling apart and the metals were surging, we did see a pretty big spike in sales then. But I mean, outside of that, it's just been sustained buying. I mean, it's quite amazing as you touched, how terrible the sentiment is. The sentiment's just absolutely atrocious, and yet the market can't supply enough products. Like, can you imagine when sentiment turns and it's not even terrible, but a little bit of the population gets excited about precious metals?
And that would indeed happen if we do have another couple of weeks, 3-5 weeks of general downward action in standard equities. It'll put a fear bid into the purchase of gold and silver. And I think that's what we're setting up for.
Yeah. Well, we had an interesting week here at SDBullion. We had a visit from the third largest wholesaler of precious metals in the United States. And one thing that we were chatting with before the show that I think our listeners appreciate, we do things a bit different here with SDBullion, pretty much across the entire industry. Everybody, all the major market players, and whether it's retail dealers or the wholesalers, they hedge all of their sales. Every single ounce of gold or silver they sell, they hedge, and they hedge it to dollars. Well, they found out this week that we don't hedge to dollars, we hedge to ounces, because we're pretty strong proponents in gold and silver. And as I was chatting with Eric, I don't want to be hedged to the dollar if the dollar hyperinflates. We want to make sure we maintain a core position of gold and silver ounces, and that kind of blew them away. They couldn't fathom why anyone would want to be hedged to physical gold or silver rather than dollars. That's just too volatile, they thought.
Yeah, I think you should explain a little bit about the mechanics of how you do that, because I don't think the average person will know exactly what you mean unless you spell it out.
Sure. Basically, rather than hedging every sale or purchase with a paper hedge the opposite way, we believe in hedging, trying to keep the same amount of ounces on hand. So if we sell 500 ounces, if we sell 1,000 ounces, we go ahead and replace that inventory to make sure that we have those same amount of ounces. So sure.
And it's priced at that moment in time, so you get a better price. It's kind of like dollar cost averaging in a way of speaking.
Right. So I mean, silver goes down to $14. Company valuation dollar-wise, we're down just like anybody listening to this show who's purchased their metals at $30 an ounce. But we're just like you. We're holding the same amount of ounces, and I mean, we have a long-term fundamental belief that gold and silver are headed higher. And I don't want to be short 500,000 ounces of silver when silver finally makes its move on the paper markets.
Right.
But it's quite interesting, just the perspective. The big corporate companies, they can't fathom why you would want to have that type of philosophy and not just hedge everything to dollars.
Yeah, and a message to all your competitors, they should be doing stuff like this, because if the majority of the coin industry, the bullion sellers, were doing this stuff, it would actually improve the physical market. And when people are in the business and they're seeing a lot of price declines, and maybe even sellers are stepping up to the plate and buying the decline on the dips all the way down, it's not the same thing as if, in addition to that purchasing power, that the coin dealers themselves were buying to match the ounces in a dollar cost averaging form of hedging as well. So It's a great idea. When Doc first told me about it, I was kind of taken aback, thinking, well, gee, it would have been nice if more of the industry was already doing this kind of thing. Certainly for average, or not that it's harder for AppNext, for example, to execute something like this, just given the given the size of the company. But it would be wonderful if more dealers were to do the kind of thing that you guys are doing.
Kind of like what you're saying. I mean, otherwise, if you stack 500 ounces, 20 ounces, whatever it is, your dealers kind of on the paper market, they're offsetting that with a silver short. So
exactly. Yeah, it actually adds gasoline to the fire in the paper markets when the COMEX is going through its downdrafts, whether it's the cartel starting a down move or the copycat hedge funds and all the other speculators following because they understand the pattern that's been established, so they're taking advantage of the cartels setting the dinner table for them, or the coin dealers themselves hedging and locking in prices by putting gasoline on the fire. The paper markets. It's funny. And it reminds me, too, about 2 weeks ago, a reasonably prominent person within the precious metal space, I'm not going to name names, but they was talking about how, part of the problem that's going on here is that all of these dealers have this huge amount of inventory on hand, and now they're looking around and seeing that the prices are declining, and they're making up this whole story about unavailability of ounces and premiums going up because they're just being stubborn and they want not to get hosed by selling at a much lower price because they had all this inventory in hand. I mean, it was a pretty cockamamie analysis, but that's one of the kind of things that were going on in this really...
I'm laughing because we would love to have that problem.
Yeah. So, anyway, it's nice to get back in the saddle and see the precious metals somewhat recuperating here, and I believe that this is a pattern we've seen as well in recent years too. We had a couple years back July marking the turn in the markets, and I think that's exactly what's going to be going on in this year.
And just to reemphasize Eric's point, I mean that third largest wholesaler in the U.S. that we had in here at SDBullion up in Michigan this week, they've literally told us that they have over 21 warehouses, typically full of gold and silver, and they've been cleaned out. So, 21 warehouses. We're not talking about like one Class 3 vault in New York or something. Just across the country, 21 warehouses, and good luck finding any silver. So.
Yeah, it's at some point we've always known that the central bank vaults, the GLD vault, and other exchange-traded product vaults, private vaults within bullion banks, I mean, the supply to be able to execute the manipulation of prices downward is greatly diminished now. And the only way to bring more metal onto the markets is with higher prices. I mean, in gold in particular, there's more of a above-ground supply that's just stored and sitting around versus silver, because silver, about half is used every year in industrial applications. And most of that ultimately ends up in the landfills of our world because it doesn't get recycled. So, we're at a stage now, I think, where this whole manipulation game, particularly since 2011 when it stepped up its activity in relationship to QE2, is shifting. It's a form of a managed retreat, what Bill Murphy at GATA has described all along, and I think that that's the stage that we're in now, and we're going to see much higher prices. And, it couldn't have come at a better time, ironically enough, for the interests of the Fed and the anti-gold establishment, because if they were successful in being able to get prices lower than where they already had pushed them, we would be looking at 20% declines in silver production and maybe 10 to 20% somewhere in gold production in the next 18 months forward because of mine closures, like mines being put on care and maintenance, the inability to get financing for mines, and the entire exploration process in the junior space just being bombed out like a nuclear bomb went off in that sector. So, in an ironic sense, this is actually a good thing for the cartel, because if they thought they had problems before, I mean, if the kind of action that was going on in July kept on going through August, September, all the way through the rest of this year, and the dreams of the various pundits looking for $700 gold, et cetera, all that, and even $350 gold at one point. That was a pretty high-profile story that was out on MarketWatch. Yeah, if those kind of prices came to the market, it would have set up the stage for the biggest bull market in precious metals in world history. I mean, we would have had a 5-year plus market, and never mind all of the contingencies and possibilities of reset and all that kind of thing that may have changed the dynamics if we just made the assumption that general market action wouldn't be changed by politics. We would have easily seen gold going to 3,000 forward just based on that kind of seeding of bull market fertile soil. So it is kind of ironic in the grand scheme of things.
Just one more topic I wanted to cover here on more evidence of the shortage. Our friend Craig Hemke over at TF Metals that we had on a couple of weeks ago, he released an excellent piece here today. He observed that in the COMEX there were 242 deliveries made yesterday in August silver. Now, August is not a deliveries month, and month to date, for the first 3 weeks, there were a total of 59 deliveries made, and there were only 16 contracts still open. And then last night, suddenly open interest surged by 251 contracts, and against those, there were 242 deliveries made. And it looks like they were all issued by JPM, and they were all stopped by ABN AMRO. So, I mean, we're talking about nearly 1.2 million ounces that suddenly, and to kind of translate the context here, that's someone who can't wait for September delivery. And the COMEX already is a very obtuse process. It's complicated, and your average mints, they don't go to the COMEX to obtain silver. They obtain it directly from the mines or from scrap supply. In general, you're only going to turn to the COMEX if you can't find it readily available elsewhere, and especially in a non-delivery month. So
yeah.
It's very interesting, and again, more evidence that it's not just a production issue on the retail side, but there's actually a shortage supply issue at the wholesale level, that somebody would suddenly come in to open up 251 contracts in August, a non-delivery month, and demand immediate delivery on 242 contracts, a little over 1.1 million ounces. I mean, that's over 35 metric tons of silver in a day in a non-delivery month.
Yeah, a lot of silver. That reminds me, too, one of the things that we're going to have to keep an eye on in the next week or 2 weeks that will be possibly very rich for market signal intelligence value is the open interest level on silver. We a couple of weeks back peaked out at over 1 million and what was it, 200,000 contracts, if memory serves, and that was the first time we'd ever crossed that level. And we saw some decline going into this July carnage period where JPM and their friends, but primarily JPM, was covering, and so the open interest declined to maybe about 10% off of that level, a little bit more actually. And if we see open interest continuing to decline as we go forward in the next couple of weeks, that's going to speak pretty strongly to the bullion banks actually trying to back up and tuck their tail between our legs when in the face of this ongoing physical demand that's being strong. But now, as we are seeing in August, the paper traders of the conventional finance world are also stepping up to the plate and buying in COMEX and buying on the LVMA. And that actually is part of the process of making the cartel cry uncle and back up. It's always great to see the physical demand there, and it usually is the main force that creates a floor, and we saw that with $14 silver, for example, in the last 90 days. But what will most likely catapult us a lot higher is the surrendering of the cartel in the face of paper traders who basically have been sitting out the market for the majority of the period since our peak in 2011. But they come back every once in a while and push the price up a lot, like they did in December through January 22 of this year. We saw a lot of paper moving in, people buying the paper, and a lot of times the stacker community doesn't recognize the importance of that because we're still not yet in a precious metals market that's defined by the physical market actually doing price discovery. And for better or for worse, this is where we are. So I think in the next week, maybe 2 weeks, but certainly within a very short period of time, we're going to actually get a lot better sense as to what the JP Morgans are going to be doing. And one of the ways that we'll be able to see it that's actually more objective than COT reports, because who the heck knows what's going on in a COT report? That all that data comes directly from the bullion banks. And the CME actually, a year and a half ago, 2 years ago, or whatever, I don't forget the exact time, but they put in a disclaimer in their reports that basically says you can't rely on the data because they get it from third parties and that they take no responsibility for the accuracy of the data.
They might as well have said this is for entertainment purposes only with that disclaimer,
exactly.
if you read it.
Anyway, on top of all of that stuff, we have what's going on in Greece. And back on June 20th, our show, we talked a lot about how people were thinking that this whole Greek saga was going to work itself out, that the referendum had defined where things were going to go, and that people were very worried about, that the whole, all year long we've been worried about a market crash possibly being triggered by what goes on with Greece, and on and on and on. And once the reneging of the Cyprus deal with the Troika was announced, it pretty much was a foregone conclusion that this particular saga was going to just peter out. Well, back in June when we were talking about it, I don't think there were that many people then who recognized that this is just that was just stage one, and now we're into stage two, where the government is being disbanded. Cyprus resigned last night. There's going to be new elections. It's just a question of whether or not they're so-called snap elections, where it happens on September 20th per what Cyprus is trying to do. And the reason why he's targeting a faster time frame is because he's under the opinion of his remaining Syriza party members, and he will be in a better position to actually come back and be reelected, believe it or not. And there is a possibility that he might actually be able to do that. But the main takeaway point from all of this is that this is now the unfolding of this third bailout package, and ultimately I think that it's going to fail. It may take about 6 months for things to get really bad on the ground, to the point where GREXIT is talked about again, and that it actually moves forward. But there are a number of things that are different this time around than, say, even only 2-3 months ago. And the prime difference is that there's a major faction within the German establishment, led by Finance Minister Schroebel, that actually see the merits of letting Greece go and pushing them out. So I think that in 2016 we're going to see GREXIT on the table again, and it probably will happen within the first 6 months of 2016. That in turn is going to create a scenario where the euro initially is going to go under a lot of turmoil, and it's going to put in an additional incremental bid into the precious metal space. It'll be very positive for the industry. At some point, it's possible we might see a quote-unquote northern euro, where the euro just kind of disintegrates, and then the more austere Protestant ethic-driven countries of Germany and Finland, etc., band together and they create a much more stronger euro. And that would conceivably give a little bit more competition to gold, defined in terms of euro terms, but it would be a positive in terms of dollar-defined gold prices too. So all of this is still relevant for the precious metals community. And then on top of all of that, you have the systemic risk dimension, and the credit default swaps are still tied to Greek debt, and the banking sector risk associated with Greece under turmoil. None of that has gone away. It's still here, even though it's no longer daily headlines. I mean, from like March through July, there never was a day that you would turn to Zero Hedge and see one or two, or the lack of one or two stories on Greece. And in the last month, that sort of faded away. But stay tuned, it's coming back.
All right, well, we'll certainly keep our eyes on the markets next week, both China and the U.S. market, with a bit of a rout in the U.S. underway here the second half of the week. Again, Dow down over 500 points Friday for the first time since 2011, over 1,300 points in the week, as well as the precious metals. Again, gold back above that critical number 1150. It'll be interesting to see whether it can mount an attack on 1200, which in my mind I think it'll have a bit of resistance there, as the cartel really would like to keep it from crossing back above that 1200.
Not to mention the fact that the 200-day moving average is right below 1200 too. And they will not want it to go over the 200-day moving average, because all of the technical analysts that were going berserk about a month ago saying that, oh, we're going to go to 700, et cetera, et cetera. They'll have to reconcile their charts with the fact that the precious metal space really doesn't act according to standard technical analysis. It's rather funny to watch.
So that'll be shaping up for an interesting week in the second half of next week. Who knows? It might not even take till the second half of next week. So.
Yeah, don't be surprised if we see the powers that be come in and try to buy S&P 500 futures Sunday evening, that they also try to attack gold and silver. Probably we'll see some kind of an effort as a combination 1-2 punch. But overall, the momentum has shifted and people are coming back into the space, so I think that will just be kind of a blip, nothing more.
All right, well, we'll look forward to the week's trading ahead, and as well as with the shortage situation as it continues to develop as well here in the U.S. So we'll wrap up this week's show there. So for the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets.